Hello and welcome to this session in which we would look at this exercise. This exercise illustrates the budgetary accounting. If you did not view the prior session about budgetary accounting, by all means, please do so. Also, this will illustrate modified accrual at work. So it shows you how to record transaction using modified accrual. So let's look at this county or this city or this entity. The commissioner approved a budget for the current fiscal year. It included total revenue of $860 and total appropriation of $850. And hopefully, you know what a total, what do we mean by appropriation? This is the maximum amount that they can spend, and this is the revenue that they're expected to generate. So the first thing is we're going to journalize those transactions. So prepare the journal entries as appropriate. So we're going to go through those transactions, starting with the first one. So the first entry is a budgetary entry. Let's go ahead and book this entry. So what do? Well, we estimate revenue to be $850. So we're going to have a debit column, and we're going to have a credit column. We're going to start the debit and the credit. So we're going to debit estimated revenues $860. We're going to credit appropriation $850. Well, let me take a look at the numbers. Yes, it's $850 and $860. $860 in revenues, $850 of appropriation. But I think I made a mistake. Isn't revenue should be credit and appropriation should be debit? Well, no. Revenues, actually, this is not revenue, this is estimated revenues. And I talked about this account in the prior session. Estimated revenue is a budgetary account. So what we are dealing here is what we called budgetary accounts. So those are budgetary accounts. Now, but the entry does not balance, so something is missing. Well, we estimate to bring revenues of $860, and we expect to incur expenditure or appropriations of $850. Well, the difference is $10. What do we call this difference? Well, this is basically an increase in the fund balance, basically like an increase in retained earning or equity of a business. So if you are planning to bring $850 and spend $810, the difference is an increase in fund balance. Now, this is a budgetary entry, and I'm going to highlight it in yellow. And you might be asking why. We're going to come back at the end and close this entry. Budgetary entries are closed at the end of the period. So this is the entry that's going to be closed, and it's going to be closed exactly the way that entry is highlighted. It's going to be exactly the opposite. So you always reverse this entry. So we're done with this journal entry. Number two, the county or the city ordered office supplies of $20. Now, in the private world, in private accounting, we don't do anything. If we order supplies, well, we have a purchase order, but we don't journalize anything. In modified accrual accounting, and specifically in governmental accounting, what we do, when we order something, what we do is we encumber this account. Basically, we reserve this amount to tell the people in the government that this $20 or this $20 million has been reserved. It can no longer be used somewhere else. So when you ordered something, what's going to happen is we're going to encumber it. So let's go ahead and do the encumbrance entry. So now what we're going to do, we're going to encumbered. This is entry number 2. So we're going to debit encumbrances $20 million, and we're going to credit reserved for encumbrances another $20 million. So again, what does this entry entails? Or what we're saying is, since we ordered the items, that $20 million is taken out of the spending, taken out of the budget for spending, so don't spend it. So really, if you want to look at it another way, remember we expected to spend $850 in total. We already spent $820. What we're saying is we still have $830 to spend. This is the $850 from the original budget. Okay, this is what we're saying in this encumbrance entry. Let's look at other entries. We incur the following costs paying in cash: salaries, repairs, rent, utilities, and other operating costs. So now we need to record those expenditure. And I call them expenditure because they're going to be called expenditure. So we're going to debit all these expenditure and credit, since we paid for them cash, we're going to credit cash. So there we go, 610, 40, 25. Okay, let me go ahead and debit all these expenditures. So now what's going to happen is we are recording expenditure. we're going to do, we're going to debit salaries expenditure, repairs expenditure, rent expenditures, utilities expenditures, and other operating expenditures. Now those are all debits, like kind of they are expenditure, not expenses, because we use modified accounting. 610 4025 610 4025 41 and 19, 41 and 119, and we credit cash for the total, and if I sum them all, they sum up to 835. Those are additional expenditure. Okay, let's see. So we journalize the expenditure. We ordered equipment of $9. Once again, we just placed an order. What does that mean? Just all we have to do now is encumber the account, encumber the number. So we're going to encumber the amount of $9 for the $9 million or $9 or $9,000, whatever you want to do it, for the encumbrance. Let's take a look at the next entry. We received the equipment and was billed 10 rather than 9 million. So now what happened is, in the prior entry we encumbered the asset, we encumbered the order. Notice here, so in entry 4 we encumbered $9 for the equipment. Now we notice that the equipment actually cost us 10. So what do we need to do once we receive the orders? Well, so once we receive the orders, the first thing we do is we reverse the encumbrance. So we debit this. We're going to debit reserve for encumbrances and credit encumbrance. That's what we do. So basically, this is transaction 5. This is transaction 5 highlighted in yellow. It's the opposite of the transaction that's 4. So this is transaction 4 and this is transaction 5. So the first thing we do is we reverse the encumbrance. We reverse the encumbrance. And after we reverse the encumbrance, now we are ready to record the equipment. The equipment is an expenditure. Remember, with governmental accounting, we don't record any asset. It's all expenditures. So we're going to have expenditure for the equipment. But remember, the equipment expenditure is 10 million or $10, not 9. And we're going to credit, since we're going to be paying it in the future, accounts payable 10. So this is also transaction number 5. Transaction 5. So we're done with 6. It received the previously ordered supplies and was billed for the amount originally estimated. The account to report the receipt of supplies expenditure. It does not maintain an inventory account. So basically what we're saying is the expenditure that we ordered here, we received them exactly for that amount. What should we do? Again, we're going to have to do the same thing that we did for the equipment. First, we need to reverse the encumbrance for the original amount, which was 20. Debit reserve for encumbrances and credit encumbrances. Then, since we did receive the supplies, we're gonna debit. We said we're gonna treat this as an expenditure, not inventory. We're gonna debit supplies expenditure for exactly 20. This is how much we received them at, and we're gonna have an accounts payable for 20. And what we just did, I believe we journalized all the, let's see if we journalized all the transaction or if we still have anything pending in this exercise. Oh no, actually we still have more. It earned and collected 865 million or 65,000. Now this is easy. All what I have to do is debit cash, 865, credit revenue, some sort of a revenue. We're going to look at specific revenues later on. 860, 865. Okay, so we're just finished with all 7 journal entries. Next thing they want us to do is prepare the closing entries as appropriate. Okay, so we need to know what closing entries do we prepare. And I already told you we're going to need to close the budget. and close the temporary accounts. And remember, when we close temporary accounts, encumbrances is one of those accounts that we close in case it, in case we had any encumbrances. But in this example, we don't have any because they were both closed. All the encumbrances were closed. Let's go back and look at what we have to do. First, we have to close the budget. So the budget, remember I highlighted in yellow right here. All what I have to do now is do the opposite. I'm gonna debit appropriation, debit fund balance for this amount. So I'm just gonna copy and paste. So this is the closing. I'm starting with the closing. So I close the budget. I just close them and I credit estimated revenues for 860. So this is exactly this entry and the entry when I open the budget, exactly the same. The same as original. That's done. Now I need to know my account, the accounts that I need to close, and this is basically, it's hopefully you know this. This is from your accounting knowledge, accounting 101. This account I'm supposed to close, but it's already closed. Expenditure, yes, all the expenditure I need to close. Cash I don't close, it's an asset. Again, this encumbrance was closed by itself. And again, the other encumbrance was also closed. This is an expenditure I need to close. And this is a supplies expenditure I need to close, and this is a revenue account I need to close. So let's go ahead and close them. I'm going to start with revenues. So I'm going to have to debit revenues. So I'm going to have to, oops, let me close this. Let's start with closing revenues. So I'm going to have to debit revenues. This is regular revenues. This is the revenues that I actually generated, 865. And how do revenues affect fund balance? And it increased fund balance. And credit fund balance 865. So I closed the revenues. This is done. I closed the revenues. Okay, good. Now I need to close all the expenses that I identified earlier. So basically I'm going to have to just going to go ahead, copy them all, copy all those expenditure. I'm going to, rather than debit them, I'm going to credit them. So I'm going to cut the numbers from here, cut and paste. So I'm going to credit all of those. What other expenditure do I have? I have the equipment expenditure. That's 410. What else do I have? I have the supplies expenditure 420. So I credit all of those and I'm gonna debit. So let me insert a line here. So this way I debit first. I'm gonna debit fund balance for the total, but let me just move those a little bit so we know we are and then them, so now so we know we're crediting them, and I'm gonna debit for the total, and the total is 865. Okay, notice I have revenues of 865. That's interesting. For this period I had revenues of 865 and expenditure of 865. What does that mean? From revenues over expenditure or income statement or whatever you want to call it, they are equal to each other. 865 minus 865 equal to 0. Okay. All right. So this is basically how you prepare journal entries. Would it have been the difference in the year-end financial statements if had the county not made the budgetary account? So what they're saying, if we did not make the budgetary entries, the first entry that we make, would it have been any difference? Really, there's no difference, because remember, we open the budget, then we close it. So the effect on the financial statement is nothing, zero, because the budget accounts are closed. And remember, why do we use the budget account? Is to emphasize the budget, is to keep track of our budgetary performance, because that's what the constituents are interested in, the voters, the people who wants to know about the government. They're interested in the budget and how well you are doing vis-a-vis the budget. Also the government itself, they're interested in knowing if they're staying within the budget. Okay, If you have any questions, any comments, by all means email me. And again, this is a good exercise to show you how to open the budget, how to close the budget, how to record transaction, and how to close the temporary accounts. Make sure to read the book, complete your homework, and stay motivated.